Hello everyone and welcome back. In this video, I will discuss about ISA 520 Analytical Procedures, which is one of the most practical and widely used tools in auditing. Think about this. Instead of checking every transaction, can an auditor identify issues just by analyzing trends and relationships? The answer is yes, and that is exactly what analytical procedures are all about. First of all, analytical procedures involve the evaluation of financial information through analysis of plausible relationships. In simple terms, the auditor compares current year figures with prior years and actual results with the budgets, and also financial data with non-financial data. As a result, the auditor identifies unexpected fluctuations or inconsistencies. Now, moving forward, the objective of ISA 520 is to help the auditor obtain relevant and reliable audit evidence and identify areas of potential risk. Therefore, analytical procedures are used not just for evidence but also for risk assessment and review. It is important to understand that analytical procedures are used at three key stages of the audit. First, during the planning stage, analytical procedures are used to understand the business, identify unusual trends, or to highlight the risk areas. For example, if revenue increases by 50% but expenses remain unchanged, this may indicate a risk of misstatement. And next, analytical procedures can also be used as substantive audit procedures. In this case, the auditor develops expectations and compares them with actual results, like estimating interest income based on loan balancing or, or comparing gross profit margins with industry averages. If the results match expectations, less detailed testing may be required. Finally, analytical procedures are mandatory at the completion stage of the audit. At this stage, the auditor evaluates whether the financial statements are consistent overall, make sense in light of the auditor's understanding. Therefore, this acts as a final reasonableness check. There are different types of analytical procedures, including trend analysis, like comparing financial data over time, and ratio analysis, which is all about analyzing relationships such as gross profit margin or current ratio or inventory turnover, and also includes reasonableness test, which is about developing expectations based on data. Another one is like comparison with industry data, comparing performance with competitors. The effectiveness of analytical procedures depends on the auditor's ability to develop reliable expectations. These expectations must be based on reliable data, reasonable and logical, and sufficiently precise. For example, if rent expense is fixed, the auditor can easily predict the expected amount. However, what happens if there is a difference between expected and actual results? This is where professional judgment comes in. The auditor must investigate the cause and obtain explanations from management, also perform additional audit procedures if necessary. Therefore, analytical procedures are not just about calculation, they require critical thinking. Analytical procedures are more reliable when data is from independent sources, or relationships are predictable, and controls over data are strong. On the other hand, they are less reliable when data is uncertain, or relationships are complex, or risk is high. In some situations, analytical procedures alone are not sufficient. For example, high risk areas, complex transactions, or where significant judgment involved. In such cases, the auditor must perform detailed testing. Analytical procedures help auditors see the big picture and identify unusual patterns and also focus on high risk areas. Therefore, they improve both efficiency and effectiveness of the audit. To summarize, first, analytical procedures involve analyzing relationships in financial data. Next, they are used at the planning, substantive, and completion stages. Furthermore, they help identify unusual trends and risks. In addition, auditors must investigate significant differences. Finally, analytical procedures are a powerful tool but must be used with professional judgment. In conclusion, analytical procedures allow auditors to move beyond numbers and understand the story behind the financial statements. And that's all for today. Allah Hafiz.